And now we can do the last of the videos for chapter 11 on arbitrage. Or as it says here, exchange arbitrage. So what we're talking about is the simultaneous purchase and sale of currency in different foreign exchange markets. And the goal is to profit from exchange rate differentials in two locations. So I will give you an example. You are buying dollars with your euros, and you find that in Milan, it's a little cheaper, like a tenth of a percent or less cheaper to buy them in Milan. They're selling in Milan than they're selling in London. You buy them in Milan, you instantly go over and you sell them in London, and you make money on the differential. Now, you don't do this for $1 or $2 or even a couple hundred, because the transaction costs would probably swamp it. But if you're dealing in hundreds of thousands or even $1 million or so, yeah, you can make a tidy little profit simply by putting a buy in one and putting a sell in the other. Now, what this does is when you buy them in Milan, you basically raise the demand, which will raise the price. When you go and sell them in London, you are raising the supply, which lowers the price. So gradually these two prices are going to come to be identical. But it results in, at least in theory, and certainly can in one market. Now there's 2-point arbitrage. There you've got two currencies that are traded between two financial centers. And 3-point arbitrage, well, 3 currencies, 3 financial centers. You're switching funds among the 3 currencies in order to profit from the exchange rate inconsistencies. Interest arbitrage is the process of moving funds into foreign currencies to take advantage, as it says, of higher investment yields abroad. If one country is paying more on its government bonds than the other in interest, it might be to your advantage to buy the currency and then buy their securities. Uncovered interest arbitrage is when the investor does not obtain the exchange market cover to protect the investment proceeds because of the potential for foreign currency fluctuations. So here's an example of an uncovered interest arbitrage. You have the United Kingdom's 3-month Treasury bill interest rate and the United States 3-month Treasury bill interest rate. As you can see, the rate per year is 4% higher in the United Kingdom than in the US, and the rate per 3 months, in other words, per quarter, is 1% higher. So there is an advantage to buying a UK Treasury instead of a United States Treasury. Now, covered interest arbitrage reduces the currency risk because we still have that possibility of a change in the valuation of the currency that you're purchasing in. The investor exchanges the domestic currency for foreign currency at the current spot rate, then uses the foreign currency to finance the foreign investment by the bond. The investor also contracts in the forward market to sell an amount of the foreign currency that will be received as proceeds from this investment. The delivery date should coincide with the maturity of the investment. Covered interest rate arbitrage here is an example. The investor again exchanges domestic currency for foreign currency at the spot rate, contracts in the forward market to sell an amount of foreign currency. So again, you have the United Kingdom's 3-month Treasury bill interest rate. Here it was back here. In this case, it's 12% per year, whereas the United States 3-month Treasury interest rate is 8%. The uncovered interest rate differential favors the United Kingdom. It's 4 better, okay? Notice the United Kingdom again is better. But And now let's look at the rate for 3 months, okay, or a quarter. The 3-month Treasury bill gives interest rate is 3%, whereas the U.S. is 2%. The difference is 1. Now, in this case, the forward discount rate on the 3-month pound is -0.5%, percent, meaning the covered interest rate differential favoring the UK is half, okay? A percentage point, I should put it that way, excuse me. So, a lot of what's involved here is what we call market speculation. This is different. I mean, you will buy currency because you have had something made in another country and you have to pay for it. But some people, as I said, just buy currency because they can make it money in buying and selling the currency. They have no other good to sell. So speculation, you attempt to profit by trading on expectations about prices in the future. Deliberate assumptions of exchange rate risks. Now, stabilizing speculation works against market forces by moderating or reversing a rise or fall in a currency's exchange rate. This is a useful function for bankers and businesses. They seek stable exchange rates. Tell me right now, they're getting very nervous because the dollar weakened a bit. Destabilizing speculation works along with market forces by amplifying and reinforcing any fluctuations in a currency's exchange rate. They can disrupt international transactions. A high cost of hedging impedes international trade and disrupts international investment activity. You notice that there is a cost to hedging, is what they said. If it gets too high, it's going to decrease investment and trade. Last slide. Foreign exchange traders are hired. It's a career. Commercial banks hire them. Companies hire them. Central banks hire them. A trader studies factors that affect the local economies and rates of exchange, in other words, knows the market, knows the territory, then takes advantage of any perceived misvaluations of currencies by buying and selling in different foreign exchange markets. But please watch, only 15% of day traders realize a profit. I know people who were day traders, not in currency, more in stocks, and did not do well. So this is a place where you want to be careful. Okay, that's the end of the slide set and the videos for Chapter 11.